Every published trading return has a number behind the number. This is TechnoTrader Primer, our investor education series. Today, the number you will never see. In his reference work, The Encyclopedia of Chart Patterns, Thomas Bulkowski measured more than 38,000 chart patterns. The recurring shapes traders base decisions on. One stands out. The high and tight flag returns, on average, plus 69% in a rising market. The best average in the whole book. A real, carefully measured figure. And in practice, you will never see it. Because that average is built from 253 perfect trades. In each one, the buy was exactly at the breakout, the sell exactly at the peak, and no costs were counted. Here is one of those trades. The book buys at the breakout and sells at the exact top. But the top is only visible in hindsight. In reality, you enter later and exit earlier. Same pattern, smaller slice. And every real trade gives back more. You pay a cost on each one. And about half the time, price snaps straight back after the breakout, a throwback, before it continues. Stack it up, and the ideal plus 69% shrinks to a fraction of itself. Later entry, earlier exit, the throwback, the costs. What you keep is the orange slice. Bulkowski knows this. In his own introduction, he writes a section titled, quote, "I don't believe these numbers. The man who measured them is the first to tell you the ideal is not what you earn." And this is not only about chart patterns. The same logic holds for every published number. Average return, backtest, historical statistics. They all describe ideal conditions. Useful for comparison. Not what you put in your pocket. So the problem is not the number. It is how the number is read. Someone who expects the headline and earns less feels cheated, and quits. Almost always at the worst moment, at the bottom of a drawdown, just before the turn. So do not ask first how much it earns on average. Ask three other things. How often does it fail? How deep is the worst drawdown? And can you stay calm the whole way through it? The most valuable column in Bulkowski's book is not the average rise. It is the failure rate, how often a pattern simply does not work. And the gap is enormous. The high and tight flag fails essentially 0% of the time. The pennant fails 44% of the time, nearly half. The best pattern fails almost never. The worst fails almost half the time. If you look only at the average return, you cannot see which of the two you are buying. So here is the rule. The headline number tells you how well it can go. The failure rate and the drawdown tell you whether you can live with it. The first is hope. The second is a plan. We start from the other end. Drawdowns and expectations before returns, because the right expectation is what keeps you in long enough for the statistics to work in your favor. The number you will never see is that ideal plus 69%. The number that matters is the one you can sit through. The full written primer is on our site. This was TechnoTrader Primer, number 2.